Hey everyone, excited today to bring you a conversation with a couple of new friends and colleagues that I met just a couple of months ago up in Richmond, Virginia at my company's annual conference. If you don't know who I am, I'm Russ Thornton. I am a retirement advisor based in Atlanta, and I serve women across the country, helping them get ready for and transition into retirement. With the retirement theme in mind, I am particularly interested today to share this conversation and to introduce you to my two guests, Hank Sanders and Ryan Ponsford. They are both with OneTrust Home Loans. Welcome, gentlemen.
Hello.
Rather than my attempting to and potentially butchering your bios and intros, why don't you guys just introduce yourselves and tell folks a little bit about who you are and what it is you do. Hank, why don't you kick things off?
Sure, happy to, Russ. Good to be with you. Yeah, I've spent a lot of time as an advisor. I started in the industry with Merrill Lynch in 1986 and went to a few different business models and ultimately sold my practice several years ago. And for the last 6 years have been focused in on this retirement space where we're helping advisors get their hands around how to integrate housing wealth solutions into comprehensive planning.
Thanks. I want to come back to housing wealth solutions, but thanks, and I'm glad you're here, Hank. How about you, Ryan?
Well, not unlike Hank, come from the financial planning space about 20-ish years. Not quite as old as Hank, but I'm catching up, I think. So my background, I was in private banking for quite a few years. I left there, joined an independent hybrid broker-dealer RIA platform. Spent some time there managing money and really doing financial planning. And really what I was intrigued by were a few things. One is I recognized a lot of people had created wealth with real estate. So how do we effectively incorporate real estate into planning, which seemed to be a gap in a lot of advisors' business models. And the second was I really got hung up on was wealth transition, where money goes to kids. Kids tend to blow the money and hate each other. And that was a bad outcome because most people care a lot about family and their families being connected. And so over the years, I've developed a lot of tools and resources around how do we create family continuity in the planning process and transition, and also how do we make sure that real estate is being effectively incorporated into the process, which is really where Hank and I connected, was this whole housing wealth challenge. And, you know, when I first got introduced to the concept and OneTrust Home Loans and really incorporating lending into retirement planning, you know, my first reaction was very negative. I kind of freaked out about it and thought, well, no, that's not a part of it. You know, there's some core tools that go in there that made me panic. And so then I did the math and realized that the impact of incorporating equity, that's usually people's largest asset, into the retirement planning space has a tremendous positive outcome on longevity of cash flow, access to liquidity, and ultimately what the kids end up with at the end. So it's been a fascinating run, and we're still solving it, figuring it out, but happy to be here and happy to have you and guys like you that are really taking a more fiduciary approach to this whole process of retirement planning and how do we create better outcomes.
Yeah, I think our challenge today is going to be, you know, limiting the scope of our conversation. I think this could easily stretch into an hour or hour and a half or more without breaking a sweat, but we'll try to stay on task. Where I would like to start is, what the heck is a HECM?
I love it. Great question. I'll take the first go, and then Hank, you pick up pieces where I messed up. So
Sure.
HECM is a relatively unknown term. It stands for home equity conversion mortgage, which is a specific type of a mortgage. Most people have heard of reverse mortgages. And again, when I first heard of it, my first reaction was negative. I threw up on my mouth, and you know, as far as I knew, you steal homes and kids get screwed at the end, however you want to say it. That's vulgar, but a home equity conversion mortgage is a type of reverse mortgage. So it falls under that umbrella. It's a government insured program. So the FHA actually insures it, which creates a lot of protections for families. The HECM specifically has some very unique features that are designed for people in the retirement phase of life. So for example, you have to be 62 or older, at least one of the two borrowers. But it has some really unique things where most people are aware that you don't have to make payments with a reverse mortgage. You can. but payments are completely optional. So you can continue to make payments. You can make interest only. You can pay $10 a month. You can pay zero. You do still pay property taxes and insurance, just like you would on your regular mortgage, but that creates a lot of flexibility from a cash flow perspective. The other little known fact with the HECM is you can also set it up as a line of credit. So if you have a free and clear home or even a very small mortgage that you refinance and pay off, you actually have a line of credit feature that's revolving, allowing you to pull money out, make payments in, a ton of flexibility as to how you use it. The credit line actually grows every single month, giving you more access to equity. And that all happens regardless of the performance of your real estate. So once it's in place, your real estate can go up and down, and you continue to have access to this equity in your home in a very favorable, flexible way. And again, it's probably one of the most misunderstood, underutilized things in the retirement planning space today.
Hank, did he leave anything for you to cover?
It's pretty good coverage there. I would obviously point out here that, since we're talking about reverse mortgages, we now have to bifurcate, as Ryan mentioned, home equity conversion mortgage, government insured specific type of reverse mortgage. But now we actually have this group of proprietary reverse mortgages that are not part of the FHA insured program. Several different options out there. None of them have been able to replicate some of the really valuable features of the home equity conversion mortgage. And they tend to be more for the higher home values. But it is something to keep in mind as you're looking at efficient ways to bring solutions into this broader plan, that there are a couple of different types of reverse mortgages out there.
Got it. And like Ryan mentioned, I've always had this, negative reaction or negative connotation when I hear the term reverse mortgage. But after getting a better understanding, thanks to you two, about some of the benefits and some of the retirement specific benefits that can come out of a home equity conversion mortgage. Again, that's why I was excited to have this conversation, just to share a little bit more with some of my clients and other folks that might be checking this conversation out. So share a little bit, if you will, maybe Hank, you can kick this off. Share a little bit, if you will, about some of the specific retiree benefits to using or to taking out a home equity conversion mortgage, and how that might benefit them, in their retirement years, both from a cash flow standpoint as well as from having just some additional liquidity, and who knows what may come up along the way.
Yeah, absolutely. That's more than an hour to cover all of it in detail, but Ryan and I have learned a few things now, 6 years in, working with thousands of financial advisors that are beginning to understand how this needs to be part of a comprehensive plan. And so there's several different ways that the home equity conversion mortgage specifically, I think, can help a client in that distribution phase of life, or right before they get into that retirement lifestyle. And goes without saying, we're planners on this call, so we know that every client is unique, and what makes sense for that client is unique and specific to them. They get one life to live. Russ, your job as their planner to figure out what those things are and the order of their importance, and build the plan and the strategies around that. And so these home equity conversion mortgage, or anything, there's no universal, everyone should do it or no one should do it. It's unique to that client. But there are some themes that start to emerge as we have these now thousands of financial advisors that are beginning to understand how to bring this into the plan. And the first one, and Ryan's already alluded to it, is the unique nature of the line of credit on the home equity conversion mortgage. There's nothing else in the financial world that does this. And so we all know that we've had this historic run up in home equity and real estate prices around the country. And we know that things go in cycles, and that's not always going to be the case. We're going to give some of that back, some of us more than others, depending upon where you are and what may be behind door number 2 down the road for us in this economy. But the thing we're seeing advisors pick up on is that the initial line of credit is a way to put a floor under some portion of this valuable home equity that the client has built up, and it gives it a growth rate. Current rates are getting close to 7%, just like the 30-year traditional mortgages. And so you have a predictable growth rate on this access to equity. And what's so unique about it is that growth rate is divorced from the underlying asset, the house. And so the house no longer has to be appreciating for this line of credit for the client, the borrower, to have access to this tax-free asset to use for any purpose. So it's a very unique feature. As long as they are living in the home, paying their taxes and insurance, it's an open-ended growth rate. So very, very unique. And you can imagine as a planner, the different ways that could come in and potentially benefit a client. And so we're seeing one of the ways that can work, especially in the environment that we're in now, is when people retire, they are typically pulling from some distribution rate from the asset that they've accumulated. And we know as planners, that's a dangerous window, especially in the first few years, if they happen to be unlucky and get into a volatile market. And so your $1 million becomes $750,000, the 50,000 or 40,000 that you needed, you still need, even though your assets are only, worth 750, but that withdrawal rate is unsustainable and it can shorten the longevity. And so most of us are going to build some sort of buffer asset. There's a cost to doing that, no matter what you choose as that buffer asset. But there's a lot of really smart people in the thought leadership in the financial planning world that have done a lot of research, put together a lot of analytical papers and studies on how this home equity conversion mortgage line of credit may be an ideal buffer asset to use to mitigate some of that risk that is going to be present with certain clients when they happen to be unlucky and retire into a bad market. And so we're seeing that. And then probably the biggest one that we end up doing a lot of case analysis with financial advisors is when you're doing your plan for your client and they look great, right? The plan's working until you bring in some sort of spending shock. And we all know the stats, the healthcare surprise is there's a high statistical probability that happens once we cross age 65. And if the client doesn't have the type of insurance that gets activated during that, it can blow up a plan. And so advisors are beginning to understand that this line of credit can be this standby resource that grows over time. If they don't need it if they're lucky and don't have a healthcare event in retirement, they've had this other resource that they can use for other reasons, but it's there for them to use in that unfortunate but very frequent event. So I'll kind of stop there. And Ryan, if you want to pick up on a couple of them, add to.
Yeah, Ryan, anything to add to that?
The only thing I'd maybe just supplement is, at the end of the day, retirement, should be the most meaningful time of our lives, right? We all work our whole lives for that point. And really, what are we trying to solve in retirement? It's mostly a cash flow equation, right? We want to make sure we're in a good position of good cash flow. And so historically, we've always been told to pay off our mortgage for retirement. And the question is why? Well, because it's usually our biggest expense. And so we take that expense out of the equation, and now we don't need all of a sudden $5 million to retire. We can retire on $1.5 million or $2 million, which is a lot more realistic in most people's savings plans. And even that's aggressive for a lot of people, most people really. It's hard to accumulate that much wealth in a lifetime. We all have kids and we're spending it, and it's hard to do. And so what we've found is that, to your point, just from a cash flow perspective, whether it's eliminating or creating the optionality of that mortgage payment, or it's even setting these up to where you can actually take income from it, all in a tax favorable manner, this creates a lot of options and improved cash flow scenario in retirement. And then the second is you plan for the best, right? Plan for the worst, expect the best, and prepare to be surprised, right? And so somewhere in that process is kind of what Hank alluded to, is there's a what if button. If everything can look good, but if something goes sideways, do we have access to cash should we need it? And so one of the biggest things I would encourage people to do is that the natural tendency is wait until you have a problem to solve it. And in this reverse mortgage space, they've historically been used where all else has failed. And now we turn on this reverse mortgage as a last ditch effort to stay in our home. Well, if you look at this proactively, and so this blended with the third thing, which is have a plan, have a planner that designs a plan that can see everything. The biggest problem I see in working with families is they haven't hired somebody soon enough that can look at the big picture, that can go through a planning process and see how all these different parts move together. Because the timing on this works so much better if you do it sooner rather than wait until later. And there's a few reasons for that. One is, we keep talking about this compounding line of credit. If you have a compounding asset, when's the best time to start it? Right? Yesterday, right? Always, if you want to plant a tree, when's the best time to plant it? Yesterday. Well, if you can't do yesterday, today's the next best, right? And so it's the same way with that line of credit. The sooner you can start that compound, the more it's going to grow and the more use it'll have to you down the road when you actually need it. So if I'm 62, start this today, odds are when you have a need, healthcare is probably the largest financial risk most people will face. And it's most statistically of the time going to happen in your late 70s. So if you've had 10 to 15 years of this credit line growing, you might go from what was $150,000, $200,000 access resource pool of funds to a $350,000, $400,000 pool of funds. That makes a really big difference when your goal is to stay in the home and not have to go into a facility that's government funded or something, which we've found most people would prefer not to do. So, the improvement of cash flow, the ability to create options around cash flow, tax management, and then unexpected expenses, and then looking holistically at the big picture. We found families in conjunction with their advisors that do that will create far better outcomes in retirement, as well as 9 out of 10 times the kids end up with more assets because you'll be able to protect a lot of those liquid assets by having an alternative place to manage the risk of what you're doing in your typical investment portfolio. So we're kind of speaking Finglish here. So, I'm apologizing in advance to people that are listening that don't come from this industry. I feel like we're kind of having an advisor speak, but hopefully that makes some sense to people as we're trying to make it sort of real for those families that are trying to solve this stuff.
No, super helpful. To recap from my perspective, it's basically just another source of liquidity, a way to utilize what is otherwise trapped equity in your home, which gives you more optionality, more choice should you need it. Which I think I use that term a lot. Choice is always a good thing. More choice is usually a good thing. So my question is kind of playing devil's advocate. If liquidity is the primary benefit here, what are advantages to a home equity conversion mortgage over just refinancing, taking out another first mortgage, or setting up a home equity line of credit?
Great question. Yeah, that's a common one. Hank, you want to run at it first?
Yeah, I'll take a shot at it. So kind of back to the point of the big play in retirement planning is cash flow, right? That's what we're typically trying to solve with families. And so, again, unique to and specific to the individual client, maybe a cash out refinance is the right, better move, solves the problem, improves the outcome for them. But what we do have factored in now is a continued or whatever cash flow issue. We've got to make that payment. One of the things that I saw as a planner is it was standard planning is to have clients ahead of retirement to set up a home equity line of credit. Kind of a standby emergency fund if you need it. They're cheap, inexpensive. They're free in some cases. And maybe, again, that's the best thing, the right thing for a unique and specific client. But the nature of that particular strategy has some limitations, especially when you start contrasting that with how the home equity conversion mortgage line of credit works, specifically with that standby HELOC. If a client accesses that, what happens, right? They're going to have a payment. So now we're in this cash flow impact again conversation, and does that matter to this client? And then of course, those things are typically structured where they have an interest only payment for a period of 10 years, and then they amortize. So you've got an additional cash flow impact, maybe at not a great time. And so that needs to be factored in. The other thing that happens is that if the client needs access to more equity, that means the house has to have been appreciating, right? And then they have to reappraise the property. They have to reapply and requalify for this additional capacity in the HELOC, which may or may not work for them. And then the other biggie is that we saw it in 2008 and 9, and saw it a little bit again when COVID hit, is some of the banks started shutting those lines down. They truncated the line, they closed them all together. And so there's no guarantee, because you have that as a standby emergency fund, that it's actually going to be a practical solution if you actually need it. So contrast what we just talked about there with the home equity conversion mortgage line of credit. Once it's in place, it's autopilot as long as you're complying with the terms of the loan, your primary residence, you're paying your taxes and insurance, that line begins to increase, separated from whatever's happening to the value of the house. And so you've got this open-ended growth rate to this growing line of credit. And the other difference, the biggie, is that if you do end up using part of that home equity through the home equity conversion mortgage, there's no cash flow impact. There's no mandatory principal and interest payment the way there would be with other types of loans. And so I think, kind of a summary on all that is that this is maybe the most efficient way for somebody, once they cross into this retirement phase of life, to access and monetize that equity and make it useful.
Got it. Ryan, anything you'd add to Hank's comments?
No, I think he nailed that one. I'd say cash flow trumps liquidity. So I say it's first and foremost cash flow, secondary is liquidity, and this is one of the unique things that solves both.
Yeah.
So that'd be kind of my summary of all that.
Got it. So I think we've at least begun to paint a pretty clear picture of a lot of the benefits for a home equity conversion mortgage. Ryan, can you maybe talk a little bit about, maybe one or two bullet points or situational considerations where this might not make sense for someone to consider?
Yeah, good question. I'd say the biggest thing is it's timing. Like any loan, there's fees and expenses to set the thing up. This one's much like you'd see in an FHA loan. It has FHA, an insurance, a mortgage insurance premium attached to it on the front end, and one built in. You have your normal title, escrow, all those types of fees that go into it. Mm-hmm. So I'd say, like any loan, it's a holding period is really your biggest timing on it. So if you are in a home and you think you're not going to be there, our math will tell you somewhere between 18 to 24 months. So if you have a high level of confidence you're going to be moving within the next 24 months, I would say it probably makes less sense, because you just don't have time to spread out that expense. And once you move, you're going to have to, be reintroduced to new expense with your new home or whatever it is you're going to. So that's probably the biggest time we see it not making sense in those situations. Back to your point of the HELOC is a great short-term bridge. So if somebody would say, I'm going to be here for the next 24 months, and then I'm moving, or I think I'm going to be in a facility, or I want to go buy the grandkids, if you can, I'd say, let's see if you can qualify for a HELOC. Nice short-term bridge, does create cash flow constraints once you take draws and have to pay, not flexible if you need more, and it can be taken away. So it's not a great retirement tool, but it's a nice short-term bridge tool. Mm-hmm. So that's probably the biggest time I'd say it doesn't make sense. If it's a shorter term time frame or shorter term need, that just doesn't add up. The other is, there's scenarios where, we don't lend as much as you would on a traditional loan. So, because it has if you were going to assume you're not going to make payments, you can, but if you don't, that debt will accrue. And so the FHA is only going to insure a certain amount of loan to value when we make a loan. So as you tell people, you can ballpark somewhere around 50% equity that we can lend. So if you have a $800,000 house and you owe $600,000, we're probably not going to be able to refinance the full 600. So that becomes a challenge, because you have to bring cash to close that loan. Still some scenarios where that can make sense, but the other time is if you have north of about a 50% equity position, then we're really looking tight at really cash flow. What are your other assets, and it makes sense to bring some cash in order to free up the mortgage payment that might be holding you back from a cash flow perspective. So those are kind of the two main things I think that I would come up with. Hank, I don't know any others you've seen, but those are probably the most common.
Yeah, no, I think that's it. Yeah, it's, we're back to everything matters in a financial plan, and it's unique and specific to the client. So all the details around that unique client situation would come into play on whether this thing would have value beyond the cost of doing it.
Yeah. Not surprisingly, we're already knocking the door on half an hour. So you guys good for maybe another question or two, and we can wrap it up.
Yep. Yeah.
So let's kind of play this out. I don't think we need to apply numbers to it, but let's say someone's got a home that's paid off. They take out a home equity conversion mortgage, and let's say they wind up living another 20 or 30 years, but don't need it or have very little use for it. They've remained healthy, whatever the case may be. Can you guys kind of sketch out like what's the end game there? So let's say they own their home free and clear. They stay in it. They've got this line of credit through the HECM that they've set up, maybe 20 years ago. What happens mechanically in terms of them or their family being able to capture value from that home upon sale or whatever the case may be?
Yeah, it's a great question. It's actually one of the areas that there's still a lot of misunderstanding about how these things work. The best way to think about it, Russ, is it's a lot like any other type of mortgage debt. So at that point, when your specific question example there, if they have, let's just call it the, $20,000 of mortgage debt that was created with this home equity conversion mortgage, and they end up at the end 30 years later with access to $600,000 of home equity, it's a use it or lose it on this line of credit. And so if they did not use that line of credit, the ability to access equity, then all they're responsible for paying back is the mortgage debt that was created. Let's call it $20,000. And so if there are heirs that sell the property and the property's worth $500,000, they pay off the $20,000 that was owed on the home equity conversion mortgage and keep the difference. Right. Where it does get kind of interesting is that these are, we'll put a little spin on your example and say that because of the nature of these loans, they're insured and it's a non-recourse loan. Let's say they're upside down. Let's say that client actually did benefit from over the years using that equity. And let's say they owe $500,000 and the house is only worth $400,000 at the end. The heirs, the way these loans work, it's the lower of the two numbers. And so if there are heirs that want to keep the property as a legacy asset, that there'd be an appraisal that was done at the end, and the heir can keep the property for 95% of the appraised value, not the higher number that mom and dad owe in the mortgage. And so that's a unique feature to these loans.
Got it. Interesting. Yeah, really interesting. We've covered a lot. Again, in the interest in being respectful of both of your time, I've got other questions, and I'm sure this will probably seed some questions from folks that listen to or watch this conversation. But I want to come back briefly to a comment I think Ryan, you mentioned earlier in the conversation, which is an advisor's fiduciary responsibility to their clients. Could you maybe just talk a little bit or couch this home equity conversion mortgage in terms of, I guess, kind of big picture planning, and more specifically, an advisor's responsibility to at least consider whether or not something like this makes sense for a client situation?
Yeah, great question. And this is a sticky point for a lot of people because they panic. And first of all is understanding what it means to be a fiduciary. And it's kind of a murky space in the world of financial planning, especially from a client's perspective. But ultimately, as a fiduciary, you have a responsibility to do what's right for clients, right? and different licensing come with fiduciary requirements. And most advisors today hold licensing that has that fiduciary duty, which means you have a duty to your client legally to give them advice that's based on their best interest, not just based on the little amount that you might know that can sell them a thing, right? Which is a different standard. And so without getting too much in the weeds there, you know, the math has proven over and over again, math we've done, math has been done by other professionals in the marketplace. There's a lot of academic studies that will show and prove that by including housing wealth into retirement planning, we can improve cash flow, access to liquidity, more to the kids, ultimately better retirement outcomes than not including it, more often than not. And so as a professional with a fiduciary duty, we would argue you have a responsibility to share that information with the clients that you serve. Now there's a lot of hang up because reverse mortgage comes with a lot of baggage, where prior to a lot of the changes that were made over the last 5 to 7 years, there were some things in there that weren't great for clients, and a lot has been changed. You know, it used to be that if you had 2 borrowing spouses and one was under 62, they would take that person off the loan, only do it for the older person. When that person passed away, the younger one then had to pay off the loan. And so if they couldn't, they had to sell the home. And that was bad. And that created a lot of negativity around the product. And so as a fiduciary, again, you would have that responsibility to make sure you're not putting them in an awkward position. That has since been changed to know where you can now put a younger spouse on the loan, and they would still be able to stay in the home. Some of the benefits change a little bit, but they do not have to pay off the loan at the time of the first spouse leaving the home. So there's a lot of things that have changed. And in our opinion, you know, one of the great challenges as a financial advisor is your clients expect you to know everything, right? They expect you to know all things about all aspects of anything money and financial, right? From managing funds to annuities to insurance to estate planning to taxes to all this wild things. That's almost impossible to know all of it. But you have a duty to understand it to some extent. So, you know, we applaud advisors, individuals, and firms that are constantly, you would call it being a student of your craft. How do you continue to learn your craft, expand your knowledge because you feel a duty? And in some ways, Russ, the job you're in is almost a calling. Like, it's not an easy job to take responsibility for other people's finances. I know in my planning practice, I lost a lot of sleep freaking out over what was going on in the market, if my planning was doing the right things for families. And I'm sure you've experienced this. Then you have people you give advice to, they don't take it, and you're losing sleep and they seem fine with it, right? That stuff will make you nuts. So there is this duty that comes with your function. And with the fiduciary umbrella, it's also, there's a legal obligation. So we've often said, you know, once you hear how these home equity conversion mortgages and strategies can create better outcomes, you can't unhear what you've heard. And so what we're hoping is most advisors that start hearing this and now becoming aware of it feel a duty to start disclosing this to their clients. We think clients will start demanding it, and we're hoping that, you know, the industry as a whole will be more like you've been and open up yourself to experiencing it, understanding it, learning how to apply it, because we truly believe it will create better outcomes more often than not for the families that are served.
Yeah, thanks for that. One quick comment, and this is based on both conversations with both of you, but also conversations with some of my colleagues. If you're listening to this and you think, wow, this sounds great, but I've got a friend or a brother-in-law that does reverse mortgages, be careful, because not everybody has the level of understanding and experience with what we're talking about. So just, you know, be guarded and be a little skeptical if it sounds too good to be true, as the saying goes. So just to throw that quick disclaimer out. Let's wrap it up. Again, we could keep talking for hours, if not days. And I appreciate both of you guys joining me. As you just pointed out, Ryan, I consider myself a curious, continuous learner. And as much as I'm intrigued by these conversion mortgages and the work that you guys are doing, there's no way that I could get up to your level of expertise and experience with it, which is why my firm and I have partnered with folks like you to bring these solutions to my clients. Before we wrap this up, Hank, is there, we've covered a lot. If there were one thing that you could leave with our listeners or viewers, what would that one thing be?
Well, it's $1 million question.
Yeah, put you on the spot there.
Yeah, no, I think, I mean, I'm always going to come back to the absolute unique nature of every client and family. And so I think one of the biggest risks as human beings, we talk to other people that have no vested interest in our unique situation. They don't, number one, know our situation. Talking to somebody at the club, talking to a teacher, talking to whoever, and taking their advice, their opinion on things that may or may not be right, and certainly may or may not have any bearing on our unique situation. And so I'd say if you're a client of Russ's or going to become, or maybe interview Russ as a potential advisor for you, number one, congratulations, you got a good one there. But I would say that make sure, you're looking at everything. You're working with somebody that has your best interest at heart and is looking across the silos of all these individual pieces of what it takes to manage a very complex, in some situations, somebody's financial plan that can integrate all of these solutions. And somebody's got a heart for doing it the right way, like Russ, that is going to guide you and bring in these solutions when they make sense. So.
Perfect. Thanks, Hank. How about you, Ryan? If there's one thing you could leave our listeners or viewers with, what would it be?
I'd say always keep learning, right? You got one shot at this. The financial industries, any industry for the most part, medical industry, but a lot of advice is based on probability. Planning software is largely based on probability, and that's just because there's not always a better way to do it. But the fact is, you've got one life to live, and you could argue life insurance is the worst investment on the planet, because most of the time, term insurance doesn't end up paying. But if you're the one that needs it, it's the best investment you'll ever make, right? And so my take on a lot of this stuff is plan for you. To Hank's point, your situation is different than anybody else's. And, Russ has the ability to go in and look at your situation and see how does this or any of the other solutions he has apply to your situation and your outcomes. Never hurts to run an analysis and see what's going to look. Nothing obligates you to do anything that doesn't work or you don't want to do or doesn't make intuitive sense. But in my mind, it's silly to not understand something before you make a decision on it. So we would just encourage people, reach out, run it. Worst thing that happens, you say, nope, doesn't make sense in your case. No harm done. Now delete that file from your brain and move on, right? One less thing to be unsure about. There's enough lack of awareness and things to be unsure about in the world we live in. So anytime I can delete one of those, I try to. So that'd be my encouragement. Check it out. Reach out to us. See, hey, how might this fit? If it does, great. If it doesn't, no harm done. And we love this stuff, and we do this all day. And so we're having a ton of fun doing it. So again, Russ, we appreciate you and your whole team there. That's kind of embraced this next level. I think it's going to be a massively growing space. And so, we've designed our team specifically for clients that, are more affluent, that have more of these strategic cases where we can create, more looking bigger picture at their overall space. Russ mentioned earlier, the one thing Hank and I've learned, we didn't come from the reverse space. We came from the planning space. And I don't mean to knock the industry or anybody individually in the space. There's a lot of great people in the lending industry and reverse industry, but there's also a big lack of understanding of planning concepts in the industry. And so most of what we design and talk about, the industry at large has no idea what we're talking about, because it's for more affluent, more successful families that are using this proactively to create better retirement outcomes. It works if you've got no other choice, but it works really well when you use this on the forefront more strategically. So I would encourage people, give it a shot sooner than later. Don't wait until it's a need.
Awesome. I think that's a great place to put a bow on this. And Ryan, Hank, thank you both. Again, I'm Russ with Wealth Care for Women. If you have any questions about our conversation, feel welcome to reach out to me. I would be happy to connect you with Hank and or Ryan to see if one of these reverse mortgages makes sense for your situation. But as they both pointed out, it may or may not, but it's certainly worth maybe exploring and discussing further. So thank you both. I'm glad we could share this conversation with some folks today, and look forward to maybe having a part 2 sometime soon.
Absolutely. Thanks, Russ. Appreciate you.
Thank you, Russ. Appreciate you.